Watch this video till the end if you want to know the 4 primary steps to help find the types of bonds that are right for you. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. And if you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk about bond investing. I want to talk about fixed income, and I'm going to tell you the 4 primary steps that you need to follow to find the proper types of bonds that are right for your portfolio. So if you're interested in bonds but not sure where to start, let's have a conversation. And I'm going to give you 4 easy steps that you just need to follow to figure out the whole thing. But before we get into the nitty gritty, you need to understand first that you got to know your time frame and risk tolerance. There's something called risk tolerance. Risk tolerance means that you want to determine whether or not you are risk averse, you are conservative in terms of investments, or you are a risk taker. And this element of risk tolerance is inherently linked to time frame. What I'm trying to say here is that if you are in your 20s or 30s, you're not thinking the same way in terms of investment as somebody who is in his or her 40s and 50s. So time frame plays a big role in terms of investment horizon. And you also have to figure out what kind of strategy, what kind of financial goals you have, what kind of financial strategy you are pursuing in order to buy the bonds. Because bonds, as you know, bonds constitute one primary asset class in any asset allocation scheme, right? So the other primary asset class is stocks, and then you have real estate, and then you have cash and cash equivalents, and then you have all the other alternative investments. But my point here is that you have to figure out how those bonds that are going to be in your portfolio in the first place, how those bonds are going to interact with other asset classes. This is very important because when we talk about portfolio alpha and beta, you have to understand the underlying securities that constitute your portfolio and how those securities interact among themselves and interact with the outer world, with the market. So I just want to lay the foundation of today's conversation. So once that is clear, you can better understand when I talked about the 4 steps that we are going to follow. Now, the 4 steps are very simple. The first step you want to really pay attention to is that you want to first learn which types of bonds may be right for you by deciding your investment goals. So what are your investment goals? Right now, you're listening to me somewhere in the world, in the States, in Canada, in the UK, everywhere. What are your investment goals? It could be, you can say, I want to help protect my investment. So setting money aside for a near-term expense. Then you probably want to choose from this type of bonds: short-term CDs, certificate of deposits, short-term treasuries, short-term investment grade municipal or corporate bonds, or short-term bond funds, right? So if you want to protect your investment, you got to choose those 5 that I just gave you. If you want to set money for a near-term expense, you go for short-term CDs, treasuries, investment grade munis, or corporate bonds and short-term bond funds. If you say, I want to add income and balance to my portfolio, let's say you want to add income and balance to your portfolio. Are you saving for a future goal, for instance, or you're trying to potentially protect your portfolio against, let's say, some of the ups and downs of the market? Then these are the bonds you should consider: short and intermediate term treasuries, short and intermediate term agency bonds, short and intermediate terms international developed market bonds. Remember, I said developed market. I'm not asking you to go and buy bonds from a developing country. The risk might be a little high. You also want to consider short and intermediate term investment grade corporate or munis and agency mortgage-backed securities, the MBS. If you say, I want to generate interest income, let's say you want to have I would say the quintessential element of fixed income. You want to have some cash coming to you every month. If you're looking to maximize your income and willing to accept additional risk, then consider a combination of the following types of bonds to generate higher interest income. So high yield bonds or bond funds, long-term treasury or corporate or municipal bonds, emerging market bonds or bond funds, preferred securities or preferred securities funds, bank loan funds. So all of these they will provide some type of interest income to you, either on a semi-annual basis or annually, or sometimes even quarterly. But of course, with higher returns, with higher yield, come additional risk. So as long as you're able to stomach that additional risk and you're comfortable with that, and your investment horizon and your risk tolerance levels enable you to tolerate that, then go ahead and buy them. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. I hope you are still here with us, and I've been talking about giving you 4 steps you need to help find the types of bonds that are right for you, depending upon your objective. Now, so the first step was you need to learn which types of bonds may be right for you by deciding your investment goals. So I give you 3 investment goals: protect your investments, add income and balance to your portfolio, or generate interest income. Now let's go to the second step. Second, consider how long your investing horizon is. Going back to what I said earlier, traditionally, longer term bonds produce higher yields, but also have higher interest rate risk. Interest rate risk is the risk that the value of a bond will fall if interest rates rise. Therefore, your time frame may be one factor in determining the amount of interest rate risk you are willing to take on. So, low interest rate risk, you have 0 to 4 years average maturity. You have a medium interest rate risk if the bond has a maturity between 4 and 10 years average maturity, right? And the high interest rate, if you have a high interest rate risk, that's for bonds that have a maturity that spans more than 10 years. So you got to really be careful about that. And again, going back to what I said earlier, it's all about your age, your investment strategy, your financial goals. How soon would you need money? Because if you are going to buy, say, a house in 5 years or 10 years, then you can wait, right? Let's say you're in your 20s, you got your first job and you're thinking about buying a house and moving with your spouse in 10 years, then you can actually wait, and you can actually have a medium interest rate risk, and that's not a problem. But so this is a consideration that you have to think about. Consider how long your investing horizon is. And one thing I also want to mention here is that always make sure when you buy bonds that you always have to make sure the bonds that you're buying fit into your asset allocation strategy. In other words, if you chose, say, 60-40, in other words, 60 for equities and 40 for fixed income, make sure that whenever you have a change in the underlying value of the securities in your portfolio, that you rebalance to make sure that if, for instance, there is a market correction and then you have 55% for stocks and 45% for bonds, that you're able to actually buy more stock to rebalance the portfolio. So you sell a little bit of stocks and you sell a little bit of bonds, rather, to bring the percentage to 40%, and then you buy with the money that you have from the bond sale, you buy stocks to be able to bring the value back up to 60%. The third step you need to take here is to determine the level of credit risk you are comfortable with. So when we talk about bonds, you have several risks, right? Including interest rate risks and credit risk. So you got to be comfortable. You got to really determine what the kind of credit risk you're comfortable with. And this comment that I just made harks back to what I just said earlier about your risk tolerance. Folks, remember, whenever you talk about investing in the stock market, whether it is in the fixed income markets or in the equities market, you got to think about risk tolerance. What is your risk tolerance? And honestly, don't think like 1,000 words. When I'm talking to you about risk tolerance, what I'm saying here is, if you lost 5,000, for instance, let's say you lost all your investment in the market, could you sleep? Could you eat? Can your children eat? If the answer is no, then you're not ready you're not ready for the investment game. You're not. Or so risk tolerance is you gotta put in an amount that you're comfortable losing. Simple as that. So the level of credit risk you're comfortable with. So credit risk is what? It's the chance that the issuer of a bond will not be able to repay its debt obligation. So the company is filed for bankruptcy or is going through some financial problems and whatever, things happen in the market and they have to delay the payment. So with the riskier lenders, the return may be higher, but the odds of an investor losing the principal rise. So you have low credit risk. What are the bonds that you can get if you are comfortable with low credit risk? You have CDs. Those are certificates of deposit. You have treasuries. You have agency bonds, agency mortgage-backed securities. And by agency mortgage-backed securities, I'm talking about Ginnie Mae. Ginnie Mae, the credit risk is very low. But if you talk about Fannie Mae and Freddie Mac, those are also, the credit quality is high, but they're not backed by the full faith and credit of the United States government, so they're not considered low credit risk. Let's talk now about medium credit risk. If you're comfortable with bonds that have medium credit risk, then you should invest in investment grade corporate or municipal bonds, international developed market bonds. If you are comfortable with getting to the high credit risk, then you should buy the preferred securities, emerging market debt, high yield bonds, and bank loans. By the way, high yield bonds are also called junk bonds, FYI. Finally, and this is the fourth steps here, you need to determine how involved you want to be in managing your investments. This is kind of important. Now, there are two ways to do this. Actually, there are three ways. You can actually say, leave it to me. In other words, you want to do your own thing. So if you prefer to make your own investment decisions, your brokerage, whatever brokerage you currently are, whether it is Robinhood or Fidelity or Merrill Lynch or Goldman Sachs or Franklin Templeton or Charles Schwab, the brokerage has the tools to help you research, select, and monitor your own bond portfolio. So your broker's client interface automatically compares prices from multiple dealers and shows you the lowest price available. So the broker also provides history and market depth to help you choose the right bond at the right price. That's if you want to do it yourself, DIY. You're going the DIY option. The second thing is you can have a hybrid, some kind of hybrid intermediate solution where you say, you know what? You're telling the broker or you're telling your asset manager, work with me. I want you to work with me on this together. So if you'd like further guidance determining which bonds are right for you, you can get one-on-one guidance from a fixed income specialist at your brokerage company. And the fixed income specialist can help you with questions you may have around strategy, for instance, placing orders, or specific bonds. And you can also learn from the fixed income specialist how you can review your portfolio and talking bond strategy in the short and long run. So first option, you do it yourself, DIY. Second option, you do it with you do things in tandem with a specialist, a fixed income specialist at the brokerage where you are, or you can even have if you have a financial advisor who has a knack for everything investments and fixed income bonds, fixed income investments, that advisor can help you too. Yeah. So the third thing is you can say, do it for me. So first thing, you do it yourself. Second thing, you do it in tandem with the brokerage company. Or the third alternative is to say, listen, I don't want to be bothered with this. I trust you guys. Just do it for me. So if you would prefer to leave decisions about bonds to a professional, you can turn to a specialist who will professionally oversee your individual securities based on your investment style and strategy. That means you have to sit down with the fixed income specialist and go through all your goals and investment strategies and make sure they understand exactly what you want before outsourcing the oversight of your portfolio to that fixed income specialist. All right, folks, this was it for today. I really appreciate your attention. I will see you next time. But until then, remember, stay marvelous.